my name is Philippe Aghion. I teach in the economics department here, and so it's a pleasure for me to be chair of this session with Commissioner JANUSZ Lewandowski. Just a few, I want to, just very briefly introducing JANUSZ. JANUSZ has a PhD in economics from the University of the Danks. He's been one and then again between July 92 and October 93, and in particular you've turned the headquarters of the Communist Party into a stock exchange. So that's one of the highlights, and it's in fact more importantly presided over a very smart privatization process that has been contrasted with processes followed in other countries. You've been a member of Polish Parliament between 1997 and 2004. Thank you. Between 2004 and February 2010, you've been an active member of the European Parliament, and since February 2010, you are a European Commissioner in charge of budget and financial programming. So I'm sure that here we'll have plenty of questions that go beyond that, of course, about the EU budget, but that go beyond the EU budget. In particular, among questions that one might have, my own question is, do we believe that the crisis will accelerate European integration? That's a bit the Mario Monti view. In particular, you know, that we will complete liberalization of goods and services to services, that we will have a European policy of investing in infrastructure and R&D, etc. That we will go towards more, you know, more accelerated integration that might require maybe some change from German policy, away from the real deflationary policy that it has been pursuing, or not, or does it require this or does not require. So do we believe that we go towards harmony and that from the crisis more integration will follow and more harmony will follow, or instead are we more pessimistic and we believe that imbalances among EU members will increase and the Eurozone will split, or we believe that Germany anyway will pursue its deflationary policy, that other countries will adjust, but at the cost of a prolonged recession? So that those are kind of questions that people may have. The second set of questions are more generally, do we believe that the stabilization policies in which all countries now have to engage, you know, not only Greece, Spain, Portugal, France, other countries, we have to reduce public debt and our budget deficits. Can we reconcile these policies and long-run growth? Is it enough to reduce deficits, to maintain low tax, low wages, and the invisible hand of the market will do the job, and that will be enough, you know, like with the Irish approach, you know, then maintain low tax, maintain low wage, reduce deficits, and then we become an area of prosperity? Or do we believe that we need to maintain or increase investment in higher education, in training, in sectoral policy? Can we dispense with those investments, but then how can we reconcile them with the need for fiscal stabilization? So there have been ideas there that have been issued in this respect about the idea of issuing Euro bonds that would be aimed primarily at financing this long-run growth, enhancing investments. And the third kind of question has been about the Eurozone more particularly, and about the fact that, you know, when the Euro was created, people used to say that it would be a force of convergence, that countries members of the Eurozone would converge. And what we've seen, in fact, to a certain extent, they have diverged. We've seen southern members of the Eurozone specializing in non-tradable goods, housing and other non-tradables, and in fact diverging from countries like Germany that will specialize in tradable goods, exports and all that. And can we do anything to counteract this divergence? What about, you know, investing and being active in investing in Greece and in Southern Europe instead of just investing in Asia? What kind of things can be done to counteract this divergence? And the fourth type of question I have is about the EU budget. I was part of the Sapir report, so I work with André Sapir, and of course part of our discussion was about the EU budget is a small size and its composition. Not only it's small, but too much of it is about CAP. And we wanted to move away from CAP towards R&D, innovation and all that. Where is this debate today? Are we at the same stage as we were when we wrote the Sapir report, or have we moved on? And those are, I'm sure you have many more questions, but those are among the questions that I had myself. And so, but I don't want to delay any further, and maybe I should leave you the floor. And anyway, it's a pleasure to have you with us. Thank you.
Answer all in 20 minutes.
Thank you, Philippe, for your kind introduction, and a couple of questions, 100 or 200 of them. For the answer to many of them is yes, we can. To some
but we know where this leads.
No, we cannot. I hope to answer in the course of our dialogue. But first of all, let me say that I thank you for invitation to this very prestigious sanctuary of science and education. I was here precisely in this building 20 years ago, when America has discovered post-communist Europe, that something is happening behind the Iron Curtain, and the first steps of this transition of a post-communist, post-Soviet zone, Eastern Europe was provoking a lot of interest, I think, in America. Really, this was to some extent a fascinating period. I would say that this was a transition of the economy that was neither developing nor developed. This was a third category of misdeveloped economy, with a lot of industrial stock really existing in Poland, Hungary now, as it is now in China. But this was mainly built for the military aims for the Soviet Union, and not to respond to the consumer demand. Several interesting stories were already mentioned, also during the lunchtime, really, that was about the stock exchange placed in the headquarters of the Communist Party. That was a pragmatic approach. I've explained headquarters of the Communist parties around the world were very well equipped with telecommunication equipment, and this was essential for stock exchange and banking system. So this was not just a political revenge or symbolic transformation, but also very pragmatic choice. This was fin de siècle, but very optimistic fin de siècle. Nothing of the spirit of a fin de siècle. And the spirit has gone. And also the interest for Europe, I think, has gone. Now semi-communist China is provoking much more of interest than the post-communist, already normal part of Europe. And we are in the multipolar world with so many axis of division between the West and the rest. The rest is on the rise, clearly. Between the democracies and between the I would say autocratic regimes, between the surplus countries and deficit countries, between the countries that are for austerity and the countries that are spending a lot still. But in this, and this is my first point, in this very multipolar world, still US and Europe are the most interdependent on each other. Europe, that is about 20% of American export. More than 50% of overseas assets of America are placed in the European Union. The annual trade, annual flow is $1 billion daily, $1 daily. And well, still, I think we should appreciate this very deep consumer market of 500 million inhabitants of European continent, with a purchasing power on average 30,000 euro. 30,000 euro, that is a purchasing power on average. So nothing comparable still in the world. So even if we take very small Ireland, which is now making headlines, the accumulated American investment in Ireland is 165 billion euro. That is more than in China, more than in Brazil, more than in Russia and the other countries. So this is my first point. Despite the shift of interest in this interdependent world, multipolar world, the two sides of Atlantic remain the most interlocked part of the world economy. economy, and both are trying to overcome the deepest recession since the World War II. The answer, here is already Philippe with some first 100 of his questions. The answer on both sides of the Atlantic cannot be the same, because for obvious reasons. America is a federal state. Europe is not a federal state, but is the federation of sovereign states. And this is reflected in the budget. The American budget that is 23–25% of GDP of the country, federal budget of America. A European budget that is 1% of GDP of 27 countries. So there are clear limits, and this is somehow via budget reflected different structure. Federal state and the federation of sovereign states, which is the European Union, and we can discuss what is now with the European budget. I am not happy to inform that for the first time since 1984, we are not able to agree with the European budget for the next year. And before coming here, on Friday, I have signed the new version of the budget, and the new attempt will be made tomorrow, after tomorrow, this week and next week, in order to gain acceptance and possible agreement before Christmas, and give a happy message that we are entering 2011 with a budget and not without budget, that is with so-called provisional 12. So, of course, if there are different answers to the same challenge of how to overcome recession and consolidate, that is also due to this very simple fact that Europe is a federation of states, sui generis construction, not yet seen in the history of European of civilization, and America is of course a federal state. But let us go for comparison as to the political policy mix on both sides of Atlantic. And here is the big difference really. America, for good reasons, could undertake more of fiscal stimulus with a reasonable low risk. That is the fact, unique situation of America. Could afford one more quantitative easing or monetary easing by 600 billion euro. So here is the clear preference for growth and jobs, while on the other side of Atlantic there is a clear assumption that consolidation of public finances is a precondition for sustainable growth. This is different philosophy, very much visible on two sides of Atlantic. But even in the methodology of consolidating of the financial systems, we see the differences. Here this is clearly rather, if happens, about tax increases when the tax cuts, President Bush cuts expire. It will be rather about taxation, revenue side, and without touching the pension system, while I think European Union is more close to the recommendations of IMF and to the textbooks, saying that what is more conducive to a real recovery built on a sound financial system is rather cuts in spending than rising of taxation. The benchmark is the program of Mr. Cameron. In the British case, 2/3 of the adjustment program of Cameron, that is about spending. 1/3 is about on the side of taxation. In Greece, this is 51% for spending in this adjustment. In what else illustrate? In Spain, of Zapatero, 62% of adjustment of consolidation of a financial system is on the side of spending, and the rest is about revenue and taxation. And what makes difference also is Europe, aging Europe, is now more and more seeking the reform of the pension system and retirement age, even if this is so difficult as it was the case of Sarkozy. And that is the major difference in approach with the point I have made that the United States can afford, for various reasons, additional stimulus, fiscal stimulus at reasonable low risk. Many European countries cannot afford that sort of recovery type of philosophy. Therefore, austerity is the mother of all the policies on the European continent, and very much reinforced by Brussels, by bureaucrats and bureaucrats like me in Brussels. That is reinforcement of philosophy of regaining the confidence of the financial markets as a precondition for the future sustainable development. When we take what is called now the economic governance system, disciplining the countries of Europe, that is clearly straightforward message. You need to consolidate. That is even more straightforward than the message coming from the financial markets, because when we watch what is the development of financial markets in Europe, we can see that one day they are more about confidence via austerity, via consolidation of the financial systems of Greece, Portugal, Ireland. On the other day, they are more about sensitivity to what can be the economic fate of a country with such austerity. So the message coming from financial markets is more mixed than clear message coming from Brussels. You need to consolidate. You need to go forward with your austerities. Otherwise, we are to sanction you. And here is the toolbox of so-called economic governance and economic surveillance in Europe. So here are the clear differences of both sides of the Atlantic, how to deal with this post-crisis environment. The same is for regulation. I don't want to go into the regulation, which is now a response to this lost paradigm saying that was predominant since the 80s, but and has collapsed really, but about the self-regulating regulating financial markets. There are some similarities between US and Europe in this respect, but the sensitivity to risk, preoccupation with biggest banks, systemic financial institutions and so on. So we can find, and this was visible in Seoul, what are the similarities. But on the other hand, we have major differences as reflected on this side of Atlantic by, well, this is very complex name of this program, how it is called, but this is Dodd-Frank deal. Philosopher Dodd-Frank bill. This is about prohibitions, Volcker type of mentality, not to allow banks to go for risky operations, and Obama type of input that is about taxing in order to gain the financial cushion and not to delegate the problems of financial system and to upon the taxpayers. In Europe, this is more, that is, I think the line taken here is reflecting deeper mistrust towards regulation generally, which is sound, and towards to the growth of the state, because state is growing from regulation. On the other side of Atlantic, there is a propensity to regulate and to establish supervisory bodies, centralized supervisory bodies. So we have on agenda a lot of regulations about the capital requirements, about the rating agencies, about hedge funds. This is not the 1st of January. We are starting with a new systemic risk assessment agency and 3 separate supervisory bodies for banking system, pensions and capital markets. So clearly that is the choice on the other side of Atlantic in this respect, and we can continue with these similarities and differences going into the labor market and the other areas of policy mix. However, I would like to direct, and finally, perhaps because I don't know whether I am allowed to.
So I don't. We have time, I think. No,
No problem.
So as to the result, on both sides, of Atlantic, we cannot be very happy. There was, for many months, more optimistic US side vis-à-vis stagnant Europe. Europe should grow this year by 1%, European Union. Next year, the forecast, the upgraded updated forecast of European Union is 1.5. But we cannot be happy neither with growth, nor now with the developments, especially in the labor markets on both sides of Atlantic. The problems of younger generation in Europe is very much visible. However, when we read the papers now, this is not about world crisis anymore, this is about European crisis. And this is due to what was discovered now as a new paradigm and is under discussion heavily, the so-called problem of sovereign debt default. That is a new paradigm discussed under the pressure of the problems of Greece, now Ireland. Europe is reacting as a fireman, special action for Greece, now special action agreed on Sunday for Portugal. Previously this was this temporary mechanism, financial stability mechanism of 750 billion euro with involvement of my budget, because budget is a collateral partly in this financial mechanism, but these are interventionist actions. What is a really serious effort, and this is testing really the ability of Europe to move and to rise to the challenge, is what is under discussion now, apart from economic governance, but is more of fiscal coordination between the states, how to build the permanent anti-crisis resolution mechanism, not the temporary but permanent, under the German condition that we need to amend the treaty in order to involve private creditors into the action and not only the responsibility of the taxpayers. So here is a serious sovereign debt, national debt default problem, now discuss how to deal with. We can discuss the issue, but I don't want to get into the technical details. I can only say that really that is testing the crisis theory of Europe. The crisis theory of European Union says that with crisis comes the catalyst for change, for improvement. This was so true in the course of the history of the European Union, when it was stagnant and nothing happened, or the problems were accumulating. The answer was single market, then for example, common currency. So normally in the history of 50 years of European integration, Europe is rising to the challenge, responding with a new type of integration or new answers to integration. Let us hope that this time, with this deep, rather pessimistic mood of Europe, we are also capable of responding in such a way that we are illustrating the crisis theory of Europe, that is a crisis as a catalyst for improvement. And at the end I can quote the definition of a crisis, which I have found in this was a pioneering dictionary by Samuel Johnson from the 18th century. His definition was medical, because this was the definition what was crisis. The crisis is the point in which the disease kills or changes for the better. So that was the oldest definition of a crisis, and let's hope that what we are witnessing now in Europe is severe crisis, but changing for the better. I am saying as somebody coming from a very optimistic generation of solidarity, never expecting that I could be a European Commissioner in my lifetime. But so here is the basis of optimism. And now we can discuss very serious issues of America and Europe responding to more or less the same challenges. Thank you.
we have time to take questions.
Yeah. I'd like to ask a question. You mentioned fiscal coordination among nations. What form and shape is it likely to take place?
This is already more or less precise. It is starting with much better surveillance of a fiscal policy. It is called the European semester. The national budgetary plans, before being sent to the parliaments, to the national parliaments, are to be evaluated by technocrats in Brussels, whether they are improving the fiscal situation of the country or not. If not, we are sending recommendations before the parliamentary action on budget. It seems difficult, it seems controversial, but the so-called European semester has been practically politically agreed. The surveillance is going much deeper than it used to be into the so-called economic imbalances and not only the deficit. The valuation of debt, of national debt, is upgraded, but also surveillance of imbalances, competitiveness, factors of competitiveness, all of it taken into account, and again there are recommendations. But this is not the end of the story. Then starts the preventive part of this economic governance. Preventive part, that is, if there is no compliance with recommendations and nothing improves, Brussels will be imposing so-called deposits by interest-bearing deposits for the beginning of the member states. So they have to deposit money if there is non-compliance with recommendations. But for the beginning it is going to be interest-bearing deposit. If nothing happens, it is non-interest-bearing deposit, and finally converted into the fine. This is for Eurozone. What comes next, and not yet precise, are the sanctions going via budget. That is the ability to cut the structural funds for the country that is not in compliance. I am very much in favor of preventive action, because it doesn't make sense to kill the country which is almost dead when it is almost kaput, and we are imposing sanctions on the economy that is hardly alive. So prevention is better than correction in case of a country which is in real danger, because sanctioning country like Greece, for example, now would only deteriorate the position of Greece.
You had a question?
Yes, thank you very much.
You want to introduce yourself, you can.
Louis Harvard.
Yeah.
For the first time, the Commission cannot agree on the budget. That is between the 27 commissioners,
Yes.
Where you have diverging opinions. Is that also touching on the composition of the budget, which is about 130 billion euros,
Yes,
and about only 30% is of direct transfers by member states, and the rest you have to rely on member states to actually pay in. Could you illuminate us a little bit how it is composed and what the major problems are?
Of course, Europe is complex. If you are to cooperate in 27 countries, that cannot be very simple construction. There is not a problem, the disagreement is not within Commission. We have agreed our figures. The disagreement is between the governments, that is Council, and the Parliament, European Parliament growing in power. But the paradox is that this is not disagreement over the figures. Figures are more or less accepted for the 2011, but on this occasion European Parliament wanted to gain more prerogatives as a model of cooperation for the future. And at least 4 national delegations were opposing the appetite of the European Parliament, and here is the disagreement. 23 were more or less ready to accept Parliament having more, but not about figures. This was about prerogatives, the role. Everybody is now thinking what comes next after 2014, a new financial perspective. So here was the disagreement, but and I think we are now again at the table, and I am the broker. Commission is a broker, a sort of broker between these two sides. We are proposing, then governments, officials and the parliament are coming to the table and negotiating. As for the figures, agreement. As for the modality of cooperation between parliament and the representation of the member states, not quite, but I am now more optimistic. I have the signals that we could find. The second part of the question is rather on how to finance the European budget. The expenditure side is not contested, but for the future we have a problem whether we should stick to the original idea of the founding fathers of the European Union, that is that Europe should be based not on payments from Berlin, from Paris, from Warsaw or Stockholm, but on own resources. Now 76% of the budget is coming from direct payments from the capitals, and only 11% is built on own resources, but is contrary to the spirit of the treaty and certainly contradicting the vision of the founding fathers. Contradicting also the founding idea of the United States. Alexander Hamilton at the end of 18th century clearly indicated that if you want to build a stable structures, you cannot be dependent as a federal budget of the United States on the transfers from the states. It should have own resources. But any discussion of new own resources is highly unpopular in Europe now. And I remember what was the reply of Gordon Brown as a Prime Minister of UK. He said that once we tried new taxation and we lost Americas.
So, just I wanted to add, I will give floor to other. There were some ideas to increase EU budget, for example, carbon tax or carbon tariff. Is there any progress on these things, or do you think those ideas are very unlikely to
highly controversial issues? I can feel in many capitals the willingness to reduce the direct transfer because it could help in consolidation of a national finance. Therefore, we have presented a list of 6 candidates, including an energy taxation, including financial transaction taxation, including the revenue from so-called trading of CO2 emission, VAT, and and corporate taxation. But nobody is perfect, really. But Europe is in crisis or stagnating. Therefore, we cannot think too much about new charges in order to. And the reactions from many capitals are very critical. However, I have to say informally, but even if they are critical from major capitals, when you go and talk face to face, which is my job, they are encouraging to find something in order to relieve the transfer to reduce the direct transfer and help the consolidation. 6 candidates were presented.
Another question.
Well, 2 points I thought you left out.
Tell us who you
Can
are.
you,
Michael Landesmann, I am teaching for a term here in Harvard.
Professor from Austria.
Yeah, Austria.
Well, 2 points you seem to have left out from the comparison between the US and Europe. One is one has the impression that the bank consolidation process in the US is progressing much faster than in Europe, and it seems a rather important issue because the really recurrent crisis we perceive now is really a function of the very delayed and not ongoing process of bank restructuring. So tell us probably a little bit more why that is not happening and what measures could be done at the European level to do that. And the second problem, I think I came late, but Philippe probably mentioned that at the end is this problem of diverging competitiveness, which really seems to be one of the testing processes whether the euro as a system can continue to operate. And this is really a long-run structural problem because we know that a heterogeneous entity such as the European Union will have diverging competitiveness problems. As far as I see, the policy discussion is more or less left with a monitoring device, which in the past didn't seem to be a very powerful instrument to deal with such a fundamental problem. What are the ongoing discussions on that?
As I have mentioned several dimensions of the political mix or policy mix which are very important, and you can find interesting comparison, differences and resemblances between US and Europe. For example, labor markets have been left over, pension systems and so on. But as for financial systems, for America what is typical is this, and this is visible in your new regulation, how to avoid spillover effects of major banking catastrophe. And this is, the answer has been partially given. And in Europe, we have a new directive that is implementing Basel II treaty on increased capital requirements, increased capital ratio, adequacy ratio, and so on. But there is, I can agree, but here is the difference. This is so strong in America. The question how to avoid spillover, Lehman Brothers too, or that sort of effect. How to protect consumers. That is the deposit, the clients of a financial system. That is also very basic philosophy, visible when you read. I am not a specialist, but for me this is when I can comment Frank Dodd-Frank deal. That is for me visible. We are 27 countries with stress tests, for example, introduced, but not very successful, as major banks, which are now the problems for Ireland, passed the test. So the second stress test is to be conducted, but these are the banks of 27 countries. And I can only say that my country of origin, which was the only one to grow in 2009, that is Poland, was happily more conservative in banking, not so eager to enter the innovative financial instruments, and it is sometimes good to be a little bit backward and not with the pace, with the progress, because it could help. But yeah, this is interesting field of comparison, dealing with regulation of the financial sector. And the second is even more serious issue. The assumption of Eurozone was that apart from that markets should do their job, that is to differentiate the risk of the member states, of the members of the Eurozone. But for the 10 years we have the opposite development, that is somehow the German credibility was delegated to the other countries, and markets were not differentiating in the bond yields. There is systemic risk of for example, Spain versus Germany. Everybody was profiting of this high level of German, I would say, credibility. We differentiated and spreads were the late discovery. For Eurozone as such, and markets were not playing their role in disciplining, enforcing structural reforms in order to improve competitiveness and reduce the imbalances between the countries. Whether this is feasible now via the soft power of European institutions, let's hope. We see the problem, but it is not enough to consolidate the finances if there are huge differences in competitiveness between the countries. Therefore, we are now monitoring so-called, this is much more deeper surveillance of macroeconomic factors of competitiveness, depending also on much better statistics, more reliable statistics. Europe will, European institutions are not going to depend on the delivery from Warsaw or from Athens to Brussels. They are going now to for the primary statistics of the member states to check. So also the statistical issue is a lesson from this story of underestimating the threats and risks.
You see, to go back just suppose you are Southern Europe, suppose you are Spain. I don't know I don't know if Spain didn't have such a bad. No, the budgetary situation of Spain was not so. It was mainly a competitiveness problem, and they were attacked. So you are Spain, okay? Now you have Germany there with a deflationary policy, okay, which is low wage. It's a kind of China within Europe, okay? All export, low wage moderation, and we tell you, look, and you can't even invest in education or things like that because you have first to give priority to stabilizing budget. So how do you square the circle if you are Spain? What can you do? I mean, you say, how can you do it? How can you make it? That's another way to ask the question about the divergence.
But this was sounding very much typical controversy, Paris, Berlin, and Spain. Spain was called and here as a substitute for France. Nobody, Monsieur Philippe, yes. Nobody is really so naive to think, and I am not, but you can impose competitiveness from above. That is impossible. This is homework of a national politicians to be sometimes very difficult reforms, structural reforms. I would say that is my philosophy, very private philosophy. I was the first in Poland in so-called underground to present the German Ordo Liberale, that was the school of Nuremberg and Freiburg and the others. And I stick to this philosophy that you cannot build a sustainable growth on shifting sands of financial system. So this is not the malicious, for me this is not quite the malicious policy of Angela Merkel vis-à-vis France, rather than Spain. But it is good to have the country with a very solid industrial basis, competitive, export-oriented, however also taking full advantage of the currency-free European market. So even if Germany is the biggest Zahlmeister, the biggest payer, more than 20 billion euro annually to the European budget, there are clear benefits taken from this export potential in the area of 500 million consumers, richest area of consumers in the world, and 80% of advantage of a surplus is coming from the European Union. So I think that is why it is win-win situation. But as for philosophy, for economic philosophy, I have to say that Ordo Liberale way is not but Miller, Armack and Van Erfurt and
you had a ask
that's a
introduce yourself.
Now I have to start with a, what should I say, with a confession. I'm teaching also at Freiburg University. Even worse. Even worse. I was
Freiburg, but that was Aghion.
Hayek has been also there. In fact, he has been the chairman. It is even worse. I was working with the Bundesbank. In fact, on the board of the Bundesbank. Just two remarks. The first, harking back to the banking regulation issue. In the US, the number of banking institutions went down after the last crisis from 14,000 to 7,000. In Europe, we have less than 6,000 currently. So given the same size, it's not so much the dimension of banks, which is, by the way, much too big, you simply cannot rationalize it. It's much more the business lines which they have been engaged in. So it has been that incredibly leveraged, blown up investment banking, which was not so much a national issue. So we had very backward regions in Europe which haven't had anything like structured products. But it was that misallocation with regard to the structured line of business, which was forcefully underlined, emphasized, unfortunately, by Basel II. Yeah? And Basel III is not really improving on that. The important point, difference with regard to the US is, by the way, the US never applied Basel II. But in Europe it was applied all over the place. So Europe is basically doing its banking from the same script in terms of regulation. But the point I wanted to make has to do with two remarks I would like in a minute to comment on, or just to ask you a question. The first is, you said austerity is the mother of all policies. I do think the narrative is really important. Just take away the wording, look for what they did. And if you look, for example, at the German fiscal policy, it's of course wrong what Philippe said in terms of deflation. In fact, they did two discretionary fiscal policy programs, and moreover, one doesn't look at the discretionary part, one looks at the automatic part. And if you go for the whole fiscal policy, it has been more.
I was thinking of the wage policy.
More aggressive in terms of budgetary policy, more expansionary than it was done here, which the EU Commission, by the way, frequently outlines. Moreover, it has been, the two programs have been mainly towards infrastructure expenditures and R&D. So funnily enough, there's a nice piece of that, Angela Keynes. Funnily enough, if you don't look, and that's always the case, deeds speak louder than words. If you look at the deeds, it's pretty much what Philippe wanted to see. Second point.
I was referring just to the wage moderation. Huh? That was the thing.
I won't talk on that. Second point. The second point has to do with the message of the markets. And you perfectly correctly said markets have, those bond market vigilance have been sleeping for 10 years in a row. But now, interestingly enough, you would like to see these people being involved in that structured debt resolution mechanism. That's simply too difficult for me to say. So actually, what you did was during the beginning of this year, not you. But what has been done in Europe, one has been organizing in a very effective way massive uncertainty, which came at prohibitively high opportunity cost. And that's why the mechanisms we are now installing there are very nice for consistently and constantly making Europe vulnerable, namely those at the periphery. Those at the periphery with illiquid markets, which you can easily push around. So what you actually do is you introduce functionally the same as an exchange rate, because you have now that default option out there, which is in terms of, if you would write down the model, it's pretty similar to that, and that is something one should think about, not in process but in doing it.
Yeah, one short comment. Yeah, I haven't mentioned, but this is a very good supplement. Really, what was criticized as the German frugal policy, Schwäbische Frauenmarkt, and so on, was for 2010 expansion. That was fiscal expansion. Really, 2010 this was. 2011 should be, I think, different. But
9 to 10.
Yeah.
2 years.
Yes, 2 years. This was rather, that was clearly expansionary policy. And well.
No, that's right. Personally, I was referring to the wage moderation that had preceded that. By the way, when I meet with American colleagues, I ask them, Obama has lost the election a lot on employment, and you should watch, you should look to what has been done in Germany. You've done wonderful wonders in terms of subsidies to short-term employment and all the schemes you've pushed. You really focus towards employment. Maybe there is a lot for even the US and the Obama administration to learn from what has been done in Germany to fight unemployment. So I totally agree that they've done a lot. I was referring to something, to the wage moderation that preceded. Next, I know there are many more questions. You have, Sarah.
Sarah Liu, I'm here at the research scholar at University of
Another Spaniard.
for your this year. So, my question is,
Real Madrid or Barcelona?
She's French.
no, I'm French.
Ah, French, absolutely.
Hidden.
Hiding the
So, regarding the differences in policy you mentioned, only the budgetary tools, and what to say about the monetary policy, specifically the exchange rate policy? There are differences in the way they conduct this kind of policies in the US and Europe, and we know that this policy could interact in a conflictual way, so maybe some conflicts are possible.
But the answer is very clear. The Eurozone is depriving member states of autonomy in monetary policy. And now we are on the way to limit the scope of maneuver in fiscal policy in order to discipline. This is the direction. Monetary policy, that is European Central Bank. Of course, European Central Bank is a part of what was a flexible interpretation of the treaty and the mission of the European Central Bank, but because European Central Bank is buying very risky bonds and for many months and somehow monetizing the debt, somehow breaking also the original concept of European Central Bank, but this is a part of action. European Central Bank is a part of practical action now to relieve and to operate on this risky bond market. But the member states are no longer sovereign in the monetary policy, but is of course very much limiting the scope of political mix. Fiscal policy will be narrowed by the new governance. We are to introduce much more discipline and coordination in fiscal policy. However, what remains, and this was also a part of our discussion in the lunchtime, this is not the end of the story, what is to be done in Europe. That is much more than fiscal or monetary policy. Europe needs deep structural reforms of the labour market, of the pension systems. They are politically very risky, however inevitable. Even France is beginning with retirement age and successfully going via this very good propensity to go on strike in your country, but withstanding. So even as a lesson from the crisis, we are limiting the fiscal policy maneuver, and they have no monetary policy room for maneuver in the Eurozone. There is much to be done for responsible politicians in Europe in terms of labour market flexibility, in terms of pension system, retirement age, structural policy, but this is normally not very popular and not promising electoral success. I think Minister Juncker was correctly explaining the situation. He said he's from very influential minister from not the biggest state, from Luxembourg, but very influential. And he said, but practically we know what should be done in Europe. Everybody knows, but we don't know how to be re-elected when we do what we should do. That is the question of politics vis-a-vis democratic choice.
Just one thing about the fiscal. It's true that you will monitor more the budget deficit. Now you could imagine two kind of models. I mean more than two, but you could imagine the David Cameron way, which is I mainly cut spending, okay, but I maintain low tax, or to some extent, okay. So that's so I reduce tax, I reduce interest rate, and the market does the job. You can still have the Nordic model, with also reduced deficits. But they maintain, you know, highly progressive income tax to finance education, health, and things. It's another model. It's another way. They still comply in terms of budget deficits, but you could still accommodate a diversity of policies even within the constraint of controlling deficit. I mean, Goran Persson and David Cameron have not done the same policies, and so that's one question. Then the other thing on the fiscal is that Mario Monti last year would go around, I don't know if he still does it, saying, well, you know, of course we need to liberalize more services and things, but maybe this requires, you know, that we fight fiscal competition. You see, I mean, somehow to make liberalization acceptable, like for example labor markets or services, we need to have some compensation or something that require maybe some taxation, but of course to implement it, we need to fight fiscal fiscal competition. So somehow there will be a deal, you see, so that somehow if you want to make the French more liberalizing, you need to convince the Brits that, you know, fiscal competition is not the best thing. You know, I don't know how he would put the things. What is left of this Monti point, and is he still pushing this, by the way, I don't know. And is there anything of it that you, what do you make of this kind of debates?
First of all, thank you for your remark on diversity. Really, we have so many politically mixed models in Europe. There is nothing like uniformization, but what is now the Swedish fiscal position is the result of heavy austerity after the crisis. Therefore, they are not under the pressure to go for austerity in Sweden and in several Scandinavian countries. What they are, they could provide as a model for continental Europe is of course the model of so-called flexicurity,
yeah.
That is this special approach to the labor markets with much more flexibility in employing, but a clear safety net for and retraining for jobless, because what we have in Europe and what is the problem of Europe is a jobless recovery. Even if this is recovery, this is jobless recovery, and because of a much of so-called hoarding, preserving artificially in 2009 and 2008 of employment in many countries via artificial means. For recovery, small recovery, very fragile recovery is really without new jobs, and this is especially painful for the almost lost generation of younger generation in Spain and also in many countries. I am really a fan of Monti and his renewed effort for the single market, almost forgotten as the issue. But we are to build the single market without much restraint. But I am a less fan for his trade-off, because he would like to sell fiscal uniformization, taxation uniformization, if you want single market. And of course, now this is the case of Irish, put under the pressure to reduce the taxation privilege of 12.5 corporate tax, which is encouraging again American investment coming. Americans are investing in 2010, and they have a lot of new investment projects for Ireland because of this very privileged type of taxation. I think here it is 39, I don't know exactly, so corporate but makes difference between almost 40 and 12.5. I don't know whether the uniformization of taxation in Europe being rather up to this is uniformization, but down to, for example, flat in Slovakia or now the other countries is doing the best recipe for Europe's competitiveness in the future. So here I am a little bit more skeptical whether we should unify. There is a lot of what we need is uniformization of calculation base, yes, but not to allow for too many evasions, cross-border evasions, but uniformization of taxation in Europe could rather mean that we are increasing the average at the cost of competitive Europe than building competitive Europe. So here is a small disagreement with Mr. Monti, fully supported for his attempts to remind Europe that we have the mission of building a common market.
Consolidation and so on and so forth, in the context of some form of compensation, but above all, of growth. Now you mentioned the Nordic recovery from their crises, which were in the term the early 90s. Their recovery really began sort of in the middle of the 90s. The austerity response resulted in the end of the conservative government. So the success story was one where you have a number of small open economies that were able to ride, to consolidate and to make reforms, but in a context of growth in the markets on which they depended. So we're talking now about a situation which is very difficult, very different. Where is the growth going to come from? Where that would enable Europe as a whole to ride on. It seems to me that let me put it this way. Put the question to you this way: if austerity is the mother of all policies, as it is today in Europe, then everybody engages in austerity, and this guarantees that the recovery will be very slow, if not destroyed. So as growth is very low, the capacity to lower debt becomes low, and then it seems that given the present policy outlook in Europe, the only prospect is for the debt restructuring process to kick in. What happens then?
Oh, but we could speculate what happens.
First, do you agree with this scenario? Austerity,
No,
slow growth,
in
incapacity to deal to
in several countries this is a must. That is the punishment for mismanagement of economy. Really. Heavy mistakes, heavy blunders, and you cannot build economy without elementary regaining the confidence of financial markets. But of course, as I have mentioned, our Brussels recommendation towards consolidation and austerity is stronger than the message coming from the markets. Markets do understand now, after being asleep for so many years, that Greece has to repay. But Greece has to have the capacity to repay the debt. It's not just to reduce and to kill the investment, because that is depriving Greece and probably Ireland now of capacity to repay the debt. So back to the Greek mythology, the political skill is about how to navigate between the Scylla of austerity and Charybdis of reliance, recovery, and there is no uniform. We are strongly indicating that Europe should go down. Now Europe is on average 90% of debt, and that is a lot. But there are countries with more than 100. The deficit is really high, 7, 8, that is typical situation percent of GDP. Therefore, we should, with some flexibility, of course, find a reasonable way down, with a way of consolidation of the public finances. But of course, nobody is forgetting about that this is a very fragile recovery, very fragile recovery. I think we can deliver via, and here is my defense of the European budget. European budget, in contradiction to the national budgets, which are rather consumed in the annual cycle, is more about investment. It's more about multiplier effect via local investment. That is why I am defending, for example, more than 2 billion euro for Greece for the next year, because I know that this money are for the programs that could locally help to rebuild some activity, some economic activity and fiscal capacity of the country. Because the investment is normally the first to be cut in these austerity programs. Investment has no political defense. Nobody is defending political investment. There is a strong defense of trade unions, of jobs, of welfare payments. This is strongly politically defended. But investment is nobody's anonymous investment, and this is that is why this is easier to cut investment. And without investment, you have no multiplier effect locally, regionally. Therefore, in this respect, I think we can defend also the European budget, which is mainly about investment. This is the sort of structural funds that are coming into many areas. But you are right, that is about the art of navigating between Scylla and Charybdis. We owe to Greece that much, but it's not only the words like crisis is of Greek origin, but democracy is also of Greek origin.
I wanted to complete it, and now I will give the floor, because in the you say expanding is important, and austerity, and there is the whole issue of good cuts and bad cuts.
Yes.
So you want to make sure that you make the good cuts, but you don't cut, if you cut education, or if you don't, that's not so good. So it would have been great that EU budget, of course, could help, limit the extent of the bad cuts, of the cuts you don't want to make. But EU budget is very small, and a lot of it is used by CLP, is eaten up by things that we are. Maybe that's good or bad, but you see what I mean, to which extent EU budget can really, prevent, or are there other things you could do? So people have talked about, Euro bonds or other things that could, be earmarked towards making sure that the bad cuts are not made, that just the good cuts are being made. Do you have any thoughts about, what could be done there?
You are right.
And then I will give the floor.
The textbook, if we stick to the textbook recipe for consolidation, this is about, for example, welfare benefits, which are huge in Europe, and not about investment. Of course, that is easy to detect in the textbook, how to consolidate without damage to economy. European budget is small, but could be helpful, and that is why, for example, in 2009, given the restraints, we have made a lot of advanced payments locally, regionally. More than 6 billion was pushed artificially as an investment payments to several countries. European budget is an evolution. In the 80s, this was more than 60% on agriculture. But this was typical post-war generation, sensitive about sustainability and food, hungry post-war generation of Europe. Now agriculture is 40%, but this is purely communal policy. The other policies are research, many others. The European budget is coming on top of national expenditure. In agriculture, this is purely communal expenditure. So that means that if this is 40% of 1% of GDP, that is 0.4% of GDP in Europe that is on agriculture. On research we spend more. America is spending on agriculture much more than 0.4% of GDP. So we should see it in proper relations, and agriculture will be strongly defended in the future. And I know the country, Poland, does need to be on the front line in this respect, fortunately. On invitation coming from one anonymous country, 23 agricultural ministers are immediately coming. That means that only 4 are absent. That means a strong lobby. And we should be, I'm sure that agriculture will be an important part of the European budget post-2013.
Yes.
Hi, my name is Rowan Hui. I'm visiting fellow here. I'm a professor of political science, not an economist at all. I wanted
Something
to,
bad. Dismal science.
yeah, I wanted to pick up on what you said earlier today about the only good news you gave us about Latvia, this country which is an example in this atmosphere of fiscal populism. So it's a twofold question. First, could you tell us a bit more and share this your experience? And then second, do you think that you could benchmark on this? Although I'm not very confident in benchmarking, especially in financial issues. Thank you.
Yeah, while discussing today the question of politics versus economics, but there is a gap between the economic necessity to do something, for example, to reform the retirement age, but there is a gap between this necessity and the political mandate and willingness rewarded by the people. Normally they are not quite rewarding the reform which has a nature of public good, that is for the future generations, that is discounted by the today's generation and not strongly defended. Status quo is always politically better defended than the interests of the future. And here is the dilemma of this interplay between democracy and economy. However, we have clear, good examples that people do understand honest attempts to improve. Papandreou was not bad in municipal elections, for example, in Greece, although this is heavy program. I have Cameron is well understood in Great Britain. There are protests, but they do understand what he is doing. I have my younger friend Valdis Dombrovskis. He was with me in the Parliament in the European Union, and he became Prime Minister very young in the time of crisis, and Latvia was minus 18% of GDP in 2009. And his program is more painful than Greek program, and he was recently re-elected the Prime Minister he won the elections in Latvia. But that is, I would say, the society that is not so adjusted to the welfare benefits as is Western Europe. This is much more difficult to impose that sort of reform in Western Europe, because this is a model of welfare state, and post-communist societies are enjoying welfare, of course, and consumption very much, but perhaps this is easier to impose difficult programs. With Poles it wouldn't go so easily, unfortunately.
Yes.
Yeah. Yeah. You've been wonderful and very kind, but in the interest of honoring a long Harvard tradition, which is to attack the speaker,
good.
I would like to say the following and ask the following. You are not simply an analyst or a professor, you are representing the Commission, an institution here, right? And I would like to ask you about the responsibilities of the Commission. You refer to the statistics, for example. There is a long debate about this scandal that keeps on coming back and back. The Greek statistics, the Italian statistics, and You referred to the market failure both tonight and this morning, but I'm afraid the Commission did deliver a sedative for the market to go to sleep as well, and by falsifying or complying with the falsification of the statistics for far too long. Now, because Barroso has been attacked time and again for being in cahoots with the Greek Prime Minister or the Italian Prime Minister in order to be re-elected to the presidency of the Commission, and nobody from the Commission has resigned or paid any political price for this debacle. I wonder, what is your take when it comes to the... It's fine, we're talking about all these complicated things here, when we cannot do the simple thing, which is measure and deliver credible statistics. I mean, all this sounds very theoretical and out of touch with reality, as beautiful as they are, because the Commission, Europe, has failed to deliver credible statistics, and it's not that difficult. I mean, what you are now doing with Eurostat, we should have done 15 years ago. I mean, it's not that difficult to get the right statistics.
Yes.
And do away with the Greek statistics.
There was market failure, there was Eurocrat's failure as well. Too tolerant. However, discouraged by one event, famous event in the history, famous event because this was the first attempt to punish two countries, powerful countries, not complying with the Stability and Growth Pact, and these powerful countries were able to gain coalition blocking the Commission in its attempt to punish it. This was Germany and France, 2004-05. And afterwards, probably the Commission was without that energy that is needed to impose, because this is so easy to punish weakest, smallest, but well, in this respect everybody should be equal. So this is very important lesson, very important lessons for the future. That is why I was in favor of automatic sanctions and not discretionary sanctions, because with discretionary, which was Philippe was the position of Paris, to make rather discretionary sanction than automatic. Again, we are in politics. Again, we are in politics and not in benchmarks that are imposing sanctions. But of course, yes, there was this is not. The European institutions were also asleep in this pre-crisis era.
Yes?
Thanks very much. I'm Frederick Law, German Consul General. I'm speaking as a private person, and I would have a short comment and a question. The comment is that when you are apostrophizing Germany as the China of Europe, I'm not criticizing you. I would just answer with a quotation from, I think is it the Bible? That there's nothing new under the sun. We've had this before. I'm old enough to remember that. I think in the later Erhard days, the United States was telling Germany that there were too many exports, not enough imports, and this should be remedied. At that time, and here the comparison to China stops, it was possible to raise one simple question in closed circles, which was apparently, do you know who defends Berlin? Who has been defending Berlin all the time? And that more or less settled the question. Now I think things are a bit more complex. My question would be, or is that when you are quoting the disease that either kills or turns for the better, when you have two patients on both sides of the Atlantic who are suffering from this disease, and you have a few doctors, not medical ones, but PhDs of economics, who could easily communicate about this problem, is before actually taking going public and telling the press and everyone else what the solution should be, if it's not the same solution. Isn't there a kind of natural instinct for people in government. I'm not talking about central banks or people in the Commission like yourself or your other financial colleagues to take up the receiver and say, look, here's the analysis or the diagnosis. What have you been thinking about the cure and the remedy? And only then, after coming to a kind of first, second opinion, going public and taking a stand as to what should be done.
Yeah, the weak point with economics, and this is my profession, this is called dismal science, is that we are very often telling in such a way that on one side it should be done like that, on the other side, that is why I think this was President Roosevelt who once asked for one-handed economist. Yes, enough of this on one side, on the other side, as the typical economic narrative. There is no recipe that is one size suits all, of course. America, also because of the organization of the labor market, is more flexible, more free labor market, is much more sensitive to unemployment, for example, than the country with bigger social benefits and safety nets. So any increase, small increase in unemployment is immediately a political problem for Obama. And that is why rather America is for jobs and growth, clearly neglecting the issue of finance consolidation. Can afford more of fiscal stimulus, but the price will be, I think, in this multipolar world, which is no longer one superpower world. I'm afraid that this is too much neglected on this side of the Atlantic. Europe is stagnant, and will be stagnant due to austerity also, and it's also not a brilliant idea of how to move with consolidation and revive economy. Germany, Sweden, I have to say, but also Poland with almost 4% growth this year. Now these are the countries with more than 1.5% growth, but if the world is now more in trade flows and more in GDP than it was 2008, so we have recuperated, we the planet. That is not neither America nor Europe. The potential of growth and the statistics are made elsewhere and not on both sides of the Atlantic, unfortunately.
I think we should, one more question, but I think we should soon, because I think you have to get back to Brussels
to define
to budget. So yes, please introduce yourself.
I'm Grzegorz Aghion, Department of Government. The question is about the new member states. For the last 20 years, they were moving in pretty much similar direction. You think about, the policies they introduced, how to reform the economic system, then all the pressures of the association agreements and then the membership agreements. Now we see that they reacted in very different ways to the crisis. We have places like Poland which are doing extremely well, and then the Baltic republics, which were the darlings for such a long time, and now the crisis has really devastated this part of the European Union. How would you explain the differences? What's different about different parts of the new members that some were suffering from so much?
For the Baltic states, which were the primus inter pares with very high rate of growth, the small Lithuania, Latvia, Estland, the explanation is very clear. They risked the so-called pegged currency system. This was pegged to euro, and they were, all of them were absolutely open and therefore exposed to any disease coming from outside. Poland is exceptional in this area due to the huge domestic market and overconsumption. Poles are consuming like, well, like people who are hungry for 50 years, and the domestic demand is one of the fuels of economy. However, I have to say, and it will be visible, the economy is very strong. However, not much has been done in terms of public finance, and it will be visible in 2011. So the growth, the dynamics of the country was not converted into a reasonable measure of consolidation of public finance. So the major difference now is between countries that are in Eurozone, that is small Slovenia, Slovakia, and those who are now observing whether it pays to speed up accession to Eurozone, which is in the treaty. That is only the question when, not whether. Poland, Hungary, Czech Republic and all the others are, their fate is Eurozone, but of course as a zone of credibility and benefits and not payments. We've seen this very striking development in Slovakia, Eurozone member, which was under the mechanism of support to Greece, forced to pay more than, no, this is not much in American terms, more than 800 million euro for Greece, and there was resistance in the parliament. Parliament was not able to agree to the payment under the justification that Greece is more affluent than Slovakia, we shouldn't pay. And the government, who rightly so, because if this is Eurozone, there are rules of the Eurozone and they should pay, was in favor of the payment, was stopped at the parliament floor. So this is about politics, but this is not wise and not helping us, because if we should observe the rules, if there is a rescue package, we should be a part of a rescue package and not take the advantage and not the obligations of being a member of this family. So I have problems now with two countries which were, one not asked, that was Czech Republic, not asked about the position on Greece, said, but in the place of Slovakia I would do the same. That is not the display of solidarity and the understanding of the obligations that are in the family of the nations. And the second was Slovakia, and we need solidarity for the benefit of this less developed part of Europe. Still we need several years of solidarity to catch up.
Thank you very much. Thank you.